The S&P reaching a new record high somewhere between 4,800 and 5,400, he says, is coming over the next 18 months. Jan Hatzius, Goldman Sachs, reduces the recession prediction from 25 to 20. The tide has turned.
Tide has been turning. Tide has been turning. I'm cognizant of it. Look, I mean, at this point, I don't think it matters if there's a recession or not. I'm not going to say there's not going to be. And whether it's 25% or 20%, does that really matter? So the market just wants to go higher. You're looking towards the end of Fed easing. If it's not this last hike, if it's not this hike in July, it'll be the next one where it'll be the end. And then people are going to want to just put more money in there. So they've got over $5 trillion on the sidelines, and that's going to find a home, particularly with the yields having crested and coming down. So look, I think there's a case to be bullish. I still think you have to be very careful.
Wait, hold on. Would you just say?
I didn't say it was my case.
I heard it. I think that. You said, I think there's a case to be bullish?
Yeah. I forgot I have to talk so slow on this set. Yes.
Wow. What happened when I went to Tahoe? I came back and found you a new man.
Yeah. I mean,
are you looking to put more money in the market?
I haven't put money in the market and doing selectively, so I'm not all in yet. I still have a lot of bonds. As I mentioned last week, I sold some of my treasuries to fund some of my stock purchases. So I still think you have to be selective.
Okay.
And there are places to go, but look, the market has been rolling in terms of different sectors. Some haven't caught up. Some I don't think will catch up. I'm not so sure about the energy trade, and we can talk about that later.
Yeah.
But tech, I think, could still do fine, because even if tech misses, and that's going to be the critical part for the market. You've got two events coming up. You've got a minor rebalancing. Will there be some selling pressure, primarily in Apple and Microsoft, from the rebalancing, because it's gotten to be too big.
Hey, unless you already had that.
Right. And you could hedge it.
That could have accounted for some of the weakness of a couple of weeks ago.
It could have. I think some people got in front of it, but a lot of index funds can't get in front of it like that. So they typically do it on the day, right? So that caught some pressure, temporary. And then if they miss, starting next week, you really get the earnings. Get Netflix this week, but after that, that'll be the real tell in the market. But I think there's an appetite to buy them if they miss. A lot of people waiting to buy if they miss.
All right, so Shan, excuse me, is it time to get a little more optimistic, right? As Yardeni is, even he's been an outlier along the way in some respects, thinking that things were going to be better than a lot of others had expected. Now he says we can go to 5,400 over the next 18 months. Recession odds appear to be coming down in some important corners of Wall Street.
Yeah, I mean, I think the recession odds piece, Scott, is the thing that we really need to focus on. And I think the slowdown that we anticipated for this year in the economy, as well as in earnings and in corporate results, really hasn't materialized as of yet. And I think there's a lot of people sitting in the same boat that we are. We're seeing strong nominal growth, which is certainly driving, bottom line as well, although we continue to see some margin compression. If you think about those numbers, though, Scott, there's a couple of expectations that you really have to factor in. Number one, you have to anticipate to hit those numbers on the S&P 500 in terms of the multiple, because you'd have to see it in multiple expansion. Earnings aren't going to grow to justify that entirely. You'd have to expect that the slowing nominal growth that we would anticipate, because we're in a disinflationary scenario, would have to be supplanted or offset by stronger GDP and stronger secular growth. And if you look at the next 6 to 9 months, I mean, I'm not going to go out 18 months like Ed is. I think that's sort of a different time horizon than we should be focused on right now. But in the next 6 to 9 months, what is going to be the catalyst that's going to drive GDP growth to be, above 2%, to be able to justify offsetting that nominal sales slowdown? We've also had a couple of really good surprises in the first half of the year, Scott. We had AI, obviously, but we also had a less than desperate scenario in Europe in terms of energy. And we've seen strong management execution, perhaps stronger than many of us thought, in an environment where a lot of Fortune 500 companies, management teams, do not have experience in this type of inflationary scenario. So if I'm looking out and sort of projecting where those expectations are, perhaps we've seen truly a delay in the economic slowdown that we anticipated. But is it canceled? hard to say, especially with leading indicators still pointing towards that contraction.
Joey, what might be, canceled is the earnings apocalypse, because it hasn't happened, and it may not happen. Adam Parker today says the odds of